Hey guys, the purpose of this video is to explain the closing process to you guys. So closing is necessary because, think about every time Duke and Carolina have played each other in basketball. Do we start out each game with a clear scoreboard, or do we start out with however many points each team has accumulated since the beginning of the rivalry? And obviously the answer is both teams start with 0 points, and the objective is to see how many points they can score within the time that's allowed for the game. Well, with the income statement of a company, we want to start out each accounting period with $0 of revenue and $0 of expenses, and we want to see how profitable the company can be for that accounting period. Similarly, and those are the temporary accounts we're talking about here. So dividends, revenues, and expenses are all temporary accounts, and they're going to be closed out. Now, permanent accounts are all of the accounts that are on the balance sheet. So if an account is on the balance sheet, it's permanent. Let's think about it. If we had $12,200 here, and we're looking at December 31st, 2016, once the New Year's Eve ball drops and we go into 2017, is this going to magically turn to zero? The answer is no. We're still going to have that. People will still owe us $1,800. We'll still have these supplies. We will still owe people $200. It's not as though if we can ride it out until 2017, all of those things go away. So it's important that we make sure that we remember to keep all of the permanent accounts and get rid of all of the temporary. An easy way to remember it is BP. If it's on the balance sheet, it's permanent. If it's not on the balance sheet, it's going to be temporary. Okay? So these are our temporary accounts: revenues, expenses, and dividends. These are our permanent accounts: assets, liabilities, and equity. So the closing process is where we go in here and we zero all these out, so we're clearing the scoreboard, so we're starting from scratch, right? We're cleaning the slate. All of these are going to remain. Okay? So I've already mentioned this before. Feel free to pause the screen here if you would like to. So in the next couple slides, I'm going to kind of go through this, and we're going to close out our accounts that are revenues. We're going to close out our revenue accounts. I'm sorry. We're going to close out our revenue accounts, then our expenses, and then finally we're going to get rid of the dividends. It's going to be a little awkward at first. We're going to get the red out. Get out the revenues, expenses, and dividends, right? That's the slogan for Visine. Get the red out. So just remember that. These are the three things we're getting rid of when we prepare closing entries. All right? So let's take a look here. So I'm kind of buzzing through these kind of quickly, but that's just because you can pause the slide and these are in your book. I just want to kind of show you how the process works. So I'll tell you what, let's go back and take a look at this adjusted trial balance. Okay, so looking at this trial balance, we know that we are not going to get rid of anything that's on the balance sheet. We do know that we're going to have to get rid of our revenue, all of these expenses, and these dividends. Okay, so we're looking at, we currently have a credit balance of $17,500 for revenue, which makes sense because revenues should have a credit. So if we were to put this in a T account, this is what it currently looks like. How do we make $17,500 of a credit go away? With a debit. And the offset to that debit has to be a credit. So this is the journal entry we would make. So by making this journal entry, we're zeroing out revenue, and it's going into this temporary account called income summary. This account only exists for us to close the books, okay? Now keep in mind that if we're using some accounting software like QuickBooks, it's going to do all this behind the scenes, and you don't have to actually prepare these closing entries. But if we're doing a manual system, we need to do this, and we also need to understand what the software is doing. So now we've gotten rid of the revenues. Look at all these expenses. They all have a debit balance. How can we get rid of them? With credits. So the red, these are the things, these are the entries that we're going to need to make into these T accounts to zero out. So all these credits are offset by this one debit, and that debit goes to the income summary account. So currently our balance is a $1,000 or $17,500 credit offset by $8,950 debit. So we're looking at $8,550. So this is what the journal entry that we would enter into the journal, which would then be posted to the ledger, would look like. And after we're done, we would have making this entry. Now all of our expense accounts are zeroed out. The entry we made a second ago got rid of all of the revenue. What we got to do now, though, is get rid of this balance in here. And what will it take to get rid of an $8,550 credit? The answer is a debit. So this is entry number 4. And once we make this entry, you can see how we've progressed our way through here, and now we have a $0 balance. Now the cool thing is, if we go back, if we were to look at what the net income was for this accounting period, it should be equal to this amount, right? 8,550, because look, we had all of our revenues and all of our expenses, and the difference between our revenues and expenses is net income. And so we can see that we have net income in this case, don't we? Here's a picture of what the income statement would have looked like. We would have prepared this before making the closing entries, because now that we've started to make these closing entries, all of these would be just, everything on here would be zeros, okay? So we're cleaning the slate for the next accounting period. Now, if you recall, the adjusted trial balance showed dividends with a debit balance of $5,000. What's it going to take to get rid of those? You guessed it, a $5,000 credit. So this notice goes straight to retained earnings, and also this impacted retained earnings when we closed out the income summary account. All right. So at the end of the accounting period, now we have prepared the financial statements and we've gone in and cleaned the slate for the next accounting period. This was the last of the closing journal entries that was necessary. If we were to look back at the statement of retained earnings for this company, look what we've done. We've actually, this number here is equal to what ending retained earnings would be. So we've adjusted the retained earnings account to equal what was shown on the statement of retained earnings. Okay? And that's what's going to show up on the balance sheet. It's kind of like if we archived all the income, expenses, and dividends into this one number. That's what retained earnings is, isn't it? So here is a list of the 4 entries that we make in order to prepare the closing entries. There's 4 of them. Revenues. We get rid of expenses. We close income summary into retained earnings, and then we close dividends into retained earnings. Once again, this income summary account only exists very briefly, right? It exists so that we can get us a check figure to ensure that this number equals net income. And then once we make this last entry, boom, we're done. We're happy now. Revenues equal 0 for the upcoming accounting period. Expenses equal 0 for the upcoming accounting period. And dividends equal 0 for the upcoming accounting period. Now that we've made all of those closing journal entries, and recall, anytime we make a journal entry, we have to post it to the ledger or it's not going to, it's almost like it did not exist. So when we're done, all that we should see are permanent accounts because we've zeroed out all of the temporary accounts, correct? So let's take a look at this post-closing trial balance. There are no temporary accounts here, only permanent accounts. All of the temporary accounts have been rolled up and combined, and that's what is shown right here. This is equal to ending retained earnings, and that's what we've done. Isn't that interesting? Nothing but permanent accounts. All the temporary accounts have been put into this one number here. We don't see any revenues on this post-closing trial balance. We don't see any expenses, and we don't see any dividends. In essence, like I said, they've all been combined into this permanent account, which is retained earnings. And recall that retained earnings is all of the revenues and expenses that a company's ever earned since the beginning of its existence, but it's what is retained. So we have to subtract out dividends because that is earnings that are not retained. They are distributions to the shareholders or owners of the company. I hope this clarifies things. If you're still confused, please let me know, and I'll be glad to assist you. Have a wonderful day.